Every dollar sitting safely in your bank account is being charged rent, and you never signed the lease. Right now, your bank is quietly collecting 8 different fees and hidden costs from the money you worked hard to save. And the worst part? You're being punished for doing the thing everyone told you was responsible. By the end of this video, you'll know exactly how much your bank is skimming off your balance every single year, the precise dollar amount you should actually keep in your account, not a penny more, and where every cent above that line needs to go so it starts working for you instead of working for them. Here's what most people don't realize. There are really only 2 ways your money can sit. It can sit in an everyday checking or savings account, where it just exists, slowly getting picked apart by fees and losing value every month. Or it can sit inside a structure you've built on purpose, where every dollar has a job and a destination. Most people are stuck in the first one and don't even know it. A recent Bankrate survey found that nearly 1 in 3 Americans are holding $10, 0 or more, in a basic checking account, earning almost nothing. I was one of them. I had $14, 0 sitting in a Chase checking account for almost 2 years, doing absolutely nothing except making Chase richer. When I finally ran the numbers, between the monthly maintenance fees, the purchasing power I lost to inflation, and the returns I missed out on, that idle cash cost me over $2,200. Gone. Not stolen in some dramatic way, just quietly drained while I thought I was being smart. So today we're walking through the 8 ways your bank profits from your good intentions, and then I'm giving you the exact framework to fight back. Section 1, the first way your bank takes from you is the most obvious one, and somehow it's still the one people ignore the longest. It's called a monthly maintenance fee, and it's exactly what it sounds like. Your bank charges you a recurring fee every single month just for the privilege of holding your own money. Read that again. You earned it, you deposited it, and now they charge you rent to keep it in their building. Most big banks set this fee somewhere between $12 and $15 a month. Now, they'll tell you there's a way to avoid it. Keep a minimum balance, usually somewhere between $15 and $5,000, and the fee gets waived. But here's the trick. That threshold is designed on purpose to sit right in the uncomfortable zone. It's high enough that a lot of people dip below it at some point during the month, but low enough that it doesn't feel worth the hassle of switching to a different bank. So most people just eat the charge. Month after month, year after year, it's a convenience tax, and it works the exact same way a gym membership works. The gym doesn't make its money from the people who show up every day. It makes its money from the people who signed up in January, stopped going by March, and never canceled because it's only $30 a month. Your bank is doing the same thing. They're counting on you being just comfortable enough to not take action, and just busy enough to not notice what it's adding up to. Let's run the numbers. At $12 a month, that's $144 a year. At $15 a month, that's $180 a year. Over 10 years, you've handed your bank somewhere between $400 and $5,800. And what did you get for it? Nothing. Not a single extra feature. Not a higher interest rate. Not better service. You paid almost $2,000 for the privilege of doing absolutely nothing. And the frustrating part is this. There are account structures right now, in 2026, that charge 0 monthly fees with no minimum balance requirement at all. We're going to break those down later in this video. But for now, just sit with this. The very first fee on this list is one you never had to pay in the first place. Section 2. Here's something no bank will ever put on a billboard. The interest rate on your savings account isn't just low, it's actually negative. Not on paper, of course. On paper, it looks like you're earning something. But when you factor in what your dollars can actually buy, you're losing money every single month, and you won't feel it happening until it's already too late. Let me explain what I mean. Right now, most basic savings accounts pay somewhere between 0.01% and 0.5% interest per year. That's what shows up on your statement. But inflation, the rate at which prices go up on everything from groceries to gas to rent, has been running above 3% for years now. So your money is growing at less than 0.5%, while the cost of everything around you is climbing at 3% or more. That gap is real, and it's eating your balance alive from the inside. Think of it like a slow leak in a tire. Every week, you pull into the gas station and pump it back up with your paycheck. It looks full, it feels fine, but the air is constantly escaping, and no matter how many times you fill it, you're never actually getting ahead. That's what inflation does to idle cash. Your balance might read $10, 0 today, but a year from now, that same $10,000 buys you roughly $250 to $300 less in real goods and services. The number on your screen hasn't changed, but the value behind it has quietly shrunk. Now scale that up. Say you've got $20, sitting in one of these accounts. Every year, inflation is silently removing somewhere between $500 and $600 worth of purchasing power from that pile. You'll never see a withdrawal on your statement. There's no fee labeled inflation charge. It just happens invisibly, automatically, and constantly. Over 10 years, that invisible erosion adds up to $5,000 to $6,000 in lost value. That's a reliable used car. That's a family vacation. That's money you worked real hours to earn, and it just evaporated because nobody told you your account was leaking. And here's the part that really stings. This isn't something you have to accept. There are savings vehicles available right now, ones we're going to compare head-to-head later in this video, that don't just stop the leak. They actually flip it. Instead of losing ground to inflation, your money starts outpacing it. You go from sinking to swimming with the exact same balance. Section 3, this one might make you angry, and honestly, it should. Because once you understand how this works, you'll never look at your bank the same way again. Your bank is borrowing your money at almost 0%, turning around and lending it out at 7 or 8%. And that massive gap in between, that's your money they're earning, not you. Let me break this down simply. When you deposit your paycheck into a savings account, your bank doesn't just lock it in a vault somewhere. They take that money and put it to work immediately. They lend it out as mortgages, car loans, personal loans, and credit lines, all at interest rates between 6 and 10%, sometimes even higher. Meanwhile, they pay you 0.01% on your savings, maybe 0.05% if they're feeling generous. That means for every dollar you hand them, they're making roughly 700 times more from it than you are. Think of it like this. You're a farmer who grows apples. You sell your entire harvest to a middleman for 1 cent per apple. That middleman walks across the street, sets up a stand, and sells those same apples for $7 each. You did all the work. You grew the crop. You handed it over. And someone else is eating almost every dollar of profit while you walk away with pennies. That's what's happening inside your bank account right now. The banking industry has a name for this gap. They call it the net interest margin, the difference between what they pay depositors and what they earn from borrowers. And for the biggest banks in America, that margin has been one of their most reliable profit engines for decades. They don't need to sell you anything extra. They just need you to leave your money sitting there. Now let's put a dollar amount on it. Say you have $15,000 in a basic savings account paying 0.05%. That earns you about $750 a year. But if that same $15 Susan sat in a high-yield alternative paying around 4.5 to 5%, you'd earn somewhere between $675 and $750 a year. That's a gap of over $600 every single year on the same pile of money. Over 10 years with compounding, that gap grows to somewhere between $7, and $9,000 that you simply never see. Later in this video, we're going to compare the 3 best places to close that gap. High-yield savings, accounts, money market funds, and T-bill ladders, side by side, so you know exactly which one fits your situation. Section 4. This is the one that keeps me up at night, because this cost doesn't just hit you once. It hits you over and over again, and it gets bigger every single year you wait. Every year your money sits in a bank account instead of being invested. You're not just missing out on returns, you're losing the returns on those returns. And that chain reaction is where the real damage happens. Let me explain why this is so different from the other costs we've talked about. The first 3 were about money being taken. Fees, inflation, interest gaps. This one is about money that never gets created in the first place. Because investment growth doesn't work in a straight line. It works like a chain reaction. Your money earns a return. Then that return earns its own return. Then that return earns another one. Each year builds on every year before it. Mathematicians call it compound growth. I call it the single most powerful force available to regular people, and most of us are letting it sit on the bench. Think of it like a long line of dominoes. When you invest early, you tap the first domino and it sets off a chain that stretches out for decades. Each domino knocks over a slightly bigger one. By the end, the last few dominoes are massive. Those are the years where your money really explodes. But here's the problem. When you leave your cash sitting in a bank account instead, you're pulling that first domino out of the line. And when the first one is missing, every single domino behind it stays standing. The whole chain never starts. That's the true cost of delay. It's not one missed year. It's everything that year would have triggered for the rest of your life. Let's put numbers to it. Take $10,000. Put it in a savings account paying 0.5%. And after 10 years, you've got about $10,500. Now take that same $10, zero and invest it at the historical stock market average of roughly 8% per year. After 10 years, you've got around $21,500. That's an $11. Zeros and gap from the same starting amount. But stretch it to 20 years and the difference gets wild. The savings account gives you about $11,000. The investment gives you roughly $47,000. That's a gap of over $36,000. Not because you saved less, because you started later. Later in this video, I'm going to give you the exact dollar amount to keep in your bank and the exact framework for moving everything above that line into the right places so that first domino finally falls. Section 5, so now you know the 4 ways your bank has been quietly draining your money. The next question is obvious. Where should it go instead? There are 3 main options, and each one works differently. Let me walk you through all 3 side by side so you can pick the one that fits your life. The first option is a high-yield savings account. These work almost exactly like the savings account you already have. Same setup, same feel, except the interest rate is dramatically better. Right now in 2026, most high-yield savings accounts are paying somewhere between 4% and 5% per year compared to the 0.01% to 0. 5% you're probably earning now. Your money is still FDIC insured up to $250,000, which means the government guarantees it even if the bank goes under. And you can access your cash as soon as the next business day, sometimes even the same day. This is the best fit if you're the cautious type who wants better returns, but also wants to know your money is right there whenever you need it. The second option is a money market fund. This is not the same thing as a money market account at your bank. It's actually an investment product, usually held through a brokerage. Money market funds tend to pay slightly more than high-yield savings accounts, often landing in that 4.5% to 2% range right now. They're not FDIC insured, but they invest in extremely safe, short-term government debt, so the risk is about as low as it gets outside of a bank. The trade-off is access speed. Getting your money out usually takes 1 to 3 business days. This suits the person who wants to squeeze out a bit more yield and doesn't need instant access to every dollar. The third option is Treasury bills, or T-bill ETFs. These are short-term loans you make directly to the US government. They currently yield in the 4.3% to 5% range. And here's the big bonus. The interest you earn is exempt from state and local taxes. That means if you live in a high-tax state like California or New York, your effective return is even higher than it looks on paper. T-bills do come with a short lockup period, usually 4 to 12 weeks for individual bills, though T-bill ETFs let you buy and sell anytime the market is open. This is the best fit for the hands-off investor who wants a tax-smart place to park cash they won't need for a few months. So here's your simple filter. If you need your money by tomorrow, go with a high-yield savings account. If you can wait a few days and want a slightly better rate, go with a money market fund. And if you're comfortable with a short lockup and want to keep more of what you earn from taxes, go with T-bills. Section 6. This is the part you've been waiting for, the actual answer. Here's exactly how much money you should keep in your bank account and where. Every dollar above that line needs to go. First, let's get one number clear. Add up your essential monthly expenses. That means rent or mortgage, utilities, groceries, transportation, insurance, and any minimum debt payments. Don't include eating out, subscriptions, or shopping. Just the bills that keep your life running if everything else stopped tomorrow. For most people, that number lands somewhere between $2,500 and $5. 0 in a month, whatever yours is. Write it down. That single number is the foundation for everything that follows. Now here's the framework. You're going to split your money into 3 buckets, and each bucket has one job, one time horizon, and one rule you never break. Bucket 1 is your operating account. This is a fee-free checking account. No monthly maintenance fees, no minimum balance tricks. You keep exactly 1 to 1.5 months of essential expenses in here. If your essentials run $4,000 a month, that means this account holds between $4,000 and $6,000 at any given time. This is your bill-paying money, your groceries, your gas. That's it. Nothing else lives here, and nothing extra piles up here. Every month, you refill it from the other buckets, like topping off a gas tank, and you move on. Bucket 2 is your emergency reserve. This is 3 to 5 months of essential expenses, parked in a high-yield savings account or a money market fund. At $4,000 a month in essentials, that's $12,000 to $20. 0 sitting in an account earning 4% to 5% instead of 0.01%. You can access this money within 24 to 48 hours. but you never touch it unless something genuinely unexpected happens. A job loss, a medical emergency, a major repair. A vacation is not an emergency. A sale is not an emergency. This money exists to keep your life stable when real trouble hits. Bucket 3 is your growth engine. Everything above the first 2 buckets goes here. Every single dollar. This money moves into a low-cost, broad market index fund through a simple brokerage account. If you're not ready to invest in the market yet, start with T-bill ETFs inside that same brokerage. You'll still earn a strong return while you learn. This bucket has one rule that matters more than any other. You never rate it for lifestyle spending, ever. It goes in, it compounds, and it stays. One more thing. If your emergency reserve ever gets used, you rebuild it completely before you send another cent to the growth engine. The buckets refill in order, operating first, emergency second, growth third. That order protects you on the way down and builds wealth on the way up. Section 7, before we wrap up, I need you to rethink something you've probably believed your entire adult life. Because most of us were raised with this idea that a big number in your bank account means you're doing well. It feels safe. It feels responsible. You check your balance, you see 5 figures, and you think, I'm okay. I'm ahead. But after everything we've walked through today, I hope you can see that feeling for what it really is. It's not security. It's a trap dressed up as progress. A high checking account balance isn't financial health. It's financial friction. It's money sitting in a parking lot when it should be out on the road. Every dollar stuck in a low-interest account is a dollar that's being charged. Fees, eaten by inflation, exploited by the bank's lending machine, and missing out on the compounding chain that could change your future. That's not safety. That's an expensive illusion of safety. Real wealth has never been about what sits still. It's about what's in motion. It's the money that's compounding at 8% inside an index fund while you sleep. It's the emergency reserve earning 5% in a high-yield savings account while you go about your day. It's the dollars that are working shifts you never have to clock into, building something in the background, quietly, automatically, year after year. That's what a healthy financial picture actually looks like. Not a big number frozen on a screen. A system where every dollar has a job and every job is getting done. The goal was never to save more. The goal was always to save smarter. Keep what you need liquid, enough to cover your bills and handle a real emergency. Then deploy the rest. Put it somewhere it can grow. Put it somewhere it's protected from inflation. Put it somewhere your bank can't quietly skim from it every single month. Stop letting your hard-earned money sit in a vault that charges you for the privilege of doing nothing. You walked into this video thinking your bank account was a safe place. And now you know the truth. It was never free. There were always charges. There was always erosion. There was always a cost you couldn't see on your statement. But now you see it, and now you have the framework to fix it. You didn't sign that lease, so stop paying rent. Section 8 quick note before we close out. I'm not a financial advisor, and nothing in this video is personal financial advice. What I've shared today is education, tools, frameworks, and numbers to help you think more clearly about your money. Your situation is unique, so please do your own research and talk to a qualified professional before making any major moves with your finances. Now, with that said, I want to try something. Go check your savings account interest rate right now. Open your banking app, find the number, and drop it in the comments. I'm genuinely curious. Let's see who's getting the worst deal out there. Because I promise you, when you start comparing what your bank pays you versus what they earn from your deposits, the numbers are going to make this entire comment section very, very uncomfortable. And honestly, that's a good thing. That discomfort is the first step toward doing something about it. If this video opened your eyes even a little bit, if it made you rethink how your money is sitting, or if you finally ran the numbers on what your idle cash has been costing you, do me a favor and hit that subscribe button. We put out new videos every week breaking down the money systems that nobody explains in plain language. No jargon, no gatekeeping. Just the stuff you actually need to know to build real wealth on a normal income. And while you're at it, turn on notifications so you don't miss what's coming next. You can also find us on Instagram and Twitter, where we post quick breakdowns and behind-the-scenes looks at the research that goes into these videos. If you want to go even deeper, we've got a free weekly newsletter where we send out one actionable money move every single week. No spam, no fluff. Just one thing you can do in 10 minutes or less to get your finances tighter. The link is in the description. And speaking of what's next, now that you know how to structure your cash and stop the bleeding, the obvious question is, what do you actually do with that growth engine money once it's out of the bank? The next video walks you through exactly how to make your first investment, step by step, even if you've never opened a brokerage account in your life. No guessing, no second guessing, just a clear path from zero to invested. I'll see you there.